So you open up your brokerage app, right? You find a stock you like. You hit buy, boom, it's done in a fraction of a second. But do you actually know who is on the other side of that trade? Like, is it a person, a robot, some massive invisible algorithm operating in milliseconds? It's honestly such a relatable problem for so many of us. We focus so heavily on what we're buying that we just completely ignore how the machinery under the hood actually works.
Well, welcome back to The Explainer. Today, we are looking at the ultimate head-to-head showdown between America's two absolute giants, the New York Stock Exchange and the NASDAQ. You know, even seasoned traders rarely stop to think about which exchange a stock actually trades on. But as you'll see by the end of this, the exchange absolutely matters. It alters your risk, and it determines exactly who is pulling the strings behind your trades.
Okay, let's dive into this. Let's just break this down in super simple terms. Picture the New York Stock Exchange as this massive centralized auction house. It literally has a physical floor run by real human expert guides whose whole job is to match buyers with sellers. The NASDAQ, on the other hand, completely different beast. It's a decentralized, hyper-fast digital marketplace. No physical floor anywhere. It is a 100% electronic network where dealers are just fiercely competing digitally to fill your order.
Now let's zoom in on that human element at the NYSE for a second. Down on the actual trading floor, you've got a very specific type of expert known as a designated market maker, or DMM. These are highly specialized financial pros, and their entire job? Keep the chaos in check. They're essentially the referees and guides for their assigned stocks, just making absolutely sure the market stays fair, transparent, and orderly.
So how do they actually pull that off? Well, they do it in three main ways. First, they provide constant liquidity, meaning they're always sitting there with a buy and sell price, so you're never just stuck holding the bag. Second, they manage price discovery, which is incredibly important during those wild, crazy swings right at the opening and closing bells. And third, and this is massive, if there's a huge imbalance of buyers and sellers, they step in and use their own firm's capital to lessen that extreme volatility. They literally act as human shock absorbers.
All right, now compare that human element to the NASDAQ. Over on the NASDAQ, there is no single DMM acting as a referee. Instead, the whole system relies on pure, unadulterated, algorithmic speed. For any given stock, you've got an average of 14 different broker-dealers just battling it out in milliseconds to fill your order. It's basically a high-speed, high-tech competition to offer the absolute best price.
And this brilliantly illustrates how these vastly different setups attract entirely different types of companies. I mean, you can clearly see the divide, right? The NYSE is all about tradition and prestige. It's the home of those massive blue-chip financials and industrials. We're talking absolute U.S. titans like ExxonMobil, Coca-Cola, and JP Morgan. The NASDAQ, meanwhile, is built from the ground up on speed and innovation. So naturally, it attracts the tech, the biotech, and those hyper-growth sectors, giants like Apple, Amazon, and Tesla.
And you know, this whole tradition versus innovation thing starts right at the front door with their listing requirements. To even be considered for the standard NYSE, a company needs a massive $200 million market capitalization. They want the established giants. But the NASDAQ, they offer a capital market tier that lets younger, faster-growing companies get their foot in the door at just $50 million. And as you can imagine, that drastically alters the underlying risk profile of the stocks you're going to find on each exchange. But here's what most people don't know. There is this massive misconception out there in the trading world. Because we live in such a digital age, almost everyone just kind of assumes that a 100% electronic trading network, like the NASDAQ, is just inherently better, faster, and more efficient than a hybrid model with humans shouting on a floor. I mean, it sounds completely logical, right? Computers don't make emotional mistakes. Well, actually, the data tells a truly fascinating story. Back in 2020, the COVID-19 pandemic forced the NYSE to temporarily shut down its physical trading floor and go fully electronic. And a major study from the University at Buffalo analyzed exactly what happened during that time. They found that removing those human floor traders actually led to worse market quality across a whole variety of measures. Liquidity dropped, price efficiency suffered, and the quality of the auctions got completely disrupted. The hard numbers behind these studies are honestly staggering. Once the humans left the floor, pricing errors for NYSE stocks actually spiked by anywhere from 2 to 6%. It turns out, and this is wild, human floor traders facilitate the transfer of really complex information in ways that pure electronic trading just simply cannot match, especially when the market is under extreme stress and volatility.
And speaking of volatility, when you measure the average daily price swings on both exchanges, the NASDAQ is noticeably higher. Now, a quick clarification. This isn't because the Nasdaq's electronic system is inherently reckless or risky. Not at all. It is entirely because of those sectors we talked about earlier. The Nasdaq is packed with tech titans and early-stage growth companies, which just naturally swing a lot harder than the steady, dividend-paying blue chips that anchor the NYSE.
So the absolutely crucial point here, the big takeaway, is this. The exchange a stock lists on actually matters to you as a trader. It directly impacts the depth of liquidity when you're trying to quickly enter or exit a position. It dictates how wide that bid-ask spread might get during a sudden market crash. And perhaps most importantly, it's a direct reflection of the underlying sector risk that you are taking on in your own portfolio.
So, I want you to take a second today and really look at your own holdings. Seriously, check your app. Are you heavily weighted in the established, DMEM-guided blue chips of the New York Stock Exchange? Or are you out there riding the algorithmic, high-speed waves of the Nasdaq's tech innovators? Because knowing exactly where your money lives is the first step to truly mastering the market. If you loved geeking out on the hidden mechanics of the market today, make sure you hit subscribe so you don't miss our next explainer. You absolutely won't want to miss our next deep dive where we tackle another massive question: stocks versus ETFs. Which is actually better for your portfolio? Hit that subscribe button and we'll see you in the next one.